South Africa's banking sector faces risk from government debt. Interconnectedness by Satori News. South Africa's largest financial institutions are becoming a weak link in the stability of the country's economy as they increasingly hold government bonds, creating a dangerous intertwining that puts the entire financial system in jeopardy. This worrying trend signals a potential destabilization of the South African financial landscape that could have broad implications not just domestically, but across the entire African continent. Over the past decade, the South African government's fiscal health has been on a sharp decline, leading to an unsustainable situation where deficits have skyrocketed and the cost of servicing debt has reached alarming levels. Government spending has surged, pushing the national debt to a staggering 73.9% of GDP. The daily interest payments alone cost the country R1 billions, posing a grave threat to economic stability. This economic backdrop has led local financial institutions to absorb an excessive number of government bonds. The Reserve Bank of South Africa has noted that while banks holding government debt isn't inherently a problem, the current scale is dangerously high. Such concentration of government debt heightens the risk of financial shocks, volatility, and impairs the liquidity of the domestic bond market. When banks hold too much government debt, they limit their ability to spread risk and absorb potential losses, undermining their overall resilience. Alarmingly, the Prudential Authority's annual report corroborates these fears, emphasizing that the banking sector's entanglement with the government's deteriorating finances is a legitimate danger that must be addressed. The interconnectedness heightens the risk of a cascading impact throughout Africa's banking sector due to sovereign debt concerns across the continent. Increased business and consumer pressures in South Africa further compound this risk as banks are forced to shore up provisions against bad debt. The capacity of South African banks to absorb losses is still robust, but a significant rise in non-performing loans could erode this resilience and hamper their lending capabilities, thus constricting economic growth. In response, banks are taking steps to mitigate risks by working collaboratively with customers to restructure loans and enhance resilience through strict risk containment measures. The Prudential Authority also cautions banks against excessive risk-taking and urges them to tighten lending criteria, particularly in high-risk regions, until sovereign debt levels become more manageable. It is a precarious time for South Africa's banking institutions as they navigate an economically volatile environment. Continuous efforts to maintain prudent risk management and vigilant regulatory oversight will be essential in steering the country's financial system away from a potential crisis. Thank you for choosing Satori News.